Good morning, everyone. Thank you for joining us. I'm just going to give it a couple of seconds for some other attendees to join. Apologies for the late start. It said that nobody was joined, but now I realise that you were all waiting to join, so apologies for that. If you just give us a couple of seconds and then we'll get started. Okay, let's kick off. So welcome everyone to this webinar today, where we're going to talk with Dorian Cameron. We're really fortunate to have Dorian here from Thistle Initiatives to talk about the process of selling your business with defined benefit pension transfer exposure. Now, just a little bit of housekeeping before we start. So you should be able to see the question and answer functionality on your screen. We will have around 15 minutes at the end for questions, so please use that for your Q&A. If you use the chat, which I prefer you didn't, because I probably won't be monitoring it, but the chat means that everyone will be able to see your question, whereas the Q&A function keeps it anonymous for you. So we'll probably talk for around 35 to 45 minutes. And as I said, then we'll save time at the end for Q&A. Please do use that time. If we don't get through all of the questions, we'll follow up. We'll get the answers from Dorian. We'll also be passing on Dorian's contact details. But this is, you know, as interactive as we can be. This is an opportunity to talk to someone who really understands the compliance market, the buyer market, when you talk about defined benefit pension transfers. And so I will do a short market update to kick things off in a sec. And then Dorian is going to talk about effectively what buyers are looking for, where the market's at currently, and really essentially things that you can be thinking about now if you're thinking of selling in 1, 2, 3 years' time, things that you can be doing in your business so that when you go through the due diligence process and the buyer is looking under the bonnet of your business, so that the defined benefit transfer exposure has as little risk as possible from a buyer's perspective. And then following that, as mentioned, we'll go into Q&A. So I think almost everyone knows who I am, but to give you an understanding of Dorian, he's a senior compliance manager at Thistle. He's got 25 years experience in financial services. And for us, when we're working on a transaction, often with or without defined benefit transfer exposure, we will call upon Dorian and the team at Thistle to have a look at the regulatory compliance and the regulatory due diligence process when selling a business. So Dorian often works with buyers and also sellers. Often he'll be employed by a buyer to come in and look under the bonnet, as I said, but they also do a lot of, I guess, almost preventative work with sellers in advance of selling, so that when you do get to that point where the buyer's looking under the bonnet, as I mentioned, the risk profile is as small as possible and the transaction is as smooth as possible. Just a quick plug there for a bespoke market overview. If you're thinking in the next 3 to 5 years or less of selling your business, when I send these slides around in the coming days, you can click on that link and you can book in with one of my team to understand a bit more about the market, to understand a bit more about what your business might be worth, and some things that you can be doing to build value for the future. Now, picking up on the market update, as promised. Actually, this is quite an interesting market update for me. This is something that we do at the start of each webinar, and we're doing webinars every other month. And I feel like actually this is where things have shifted over the last couple of months. So what's new? Something that we're certainly finding is that, not unexpectedly, but perhaps a bit delayed from what we did expect, that we're seeing smaller buyers being put off from the M&A market due to the cost of debt, due to the inflationary environment that we have at the moment. So we're seeing either those businesses are putting on hold their acquisition plans, or perhaps they're exiting the acquisition market entirely. I think a lot of these are also using the opportunity now to spend more time on the integration of the acquisitions that they have made in the past. So of course, that integration is a big job, and there's a certain amount that you can't get away from right at the start of an acquisition. But there's a long tail of work which some of these smaller buyers who perhaps don't have the biggest acquisition teams are using this time now and the opportunity to pause new business acquisitions and focus on continuing and finalizing the integration of businesses that they have bought. The slide after this, I'm going to touch on valuation trends, but one thing that we have seen is that recurring income valuations, which tends to be more often smaller businesses or retirement businesses, we're seeing that the multiples are reducing, and we'll talk more about that in the next slide. And also something that really, is quite specific to today, and Dorian's going to pick up on this through his presentation and maybe in the Q&A. We, in our experience as the middlemen between buyers and sellers, are seeing the DBT exposure pressure for the seller easing. So what I mean by that is the scrutiny perhaps that buyers are putting on sellers in terms of the DBT work that they've done, that is easing off in some cases. And that's something that I'm keen for Dorian to sort of pick up on in his presentation. What's not new is that multi-advisor firms are still highly sought after. So when I talk about in the next slide around retirement businesses, we're seeing a lot of the large scale buyers talking about wanting acquisitions to move the needle in their financials. And so multi-advisor firms, bigger firms, are still being well competed over. And I guess to give you a bit of context, probably a buyer would look at the size of profit, and perhaps we're talking about more than $500,000 adjusted profit. When you're in more than $1 million, you're even more competed over. In reality, the higher that profit number goes, the more competition there will be to buy that business. I want to make it clear that the buyer market is still buoyant. So while smaller buyers have been put off, I mean, anyone who's spoken to us will know that we work with in excess of 150 buyers. So actually, those smaller buyers make up perhaps a large handful, but a handful of the overall buyer market. And as a result, there are still many different buyer scenarios for many different seller scenarios. And we are still seeing transactions, we're still seeing businesses come online for sale, and we're still completing transactions every month. And the final point, which leads itself into thinking about selling businesses with defined benefit transfers, is that asset purchases. So if you're a limited company where you're selling the assets out of your business, often the right to service the clients, those remain the quickest and simplest options. And whilst we may see pressure easing, we're not necessarily seeing a spike in buyers being open to buying the shares of a company with significant defined benefit transfer exposure. If we talk a little bit about valuation trends, because I tend to find this is a slide that's interesting for a lot of people. So you can see when we talk about recurring income multiples, you can see that actually there was quite a sustained period where most businesses were valued at around 3 to 3.5 times recurring income, and probably 3.25 to 3.5 times recurring income. Last year, we ended the year on a full-year average across both share and asset purchases of 4 times recurring income. And we talked a lot about that. We put that out in the press. There was significant demand and significant number of deals being done. Now, looking at the first half of this year, we have seen that easing back to more traditional levels. Now, why? Would it have been that if we hadn't seen such an inflationary rate, we would have kept multiples that bit higher? Possibly. Is it that a lot of those smaller deals are coming out of the market, and so there is both less supply and supply then sits with demand? If there isn't anything to buy, then people aren't going to look to buy it anyway. Exactly why? We don't know. I mean, certainly inflation rate pressures have put pressure on those smaller transactions, which tend to be valued on a recurring income. But as I mentioned, actually we've seen growth. I think the average is now about 8.2 times for a profit-based multiple, which more often than not will be a multi-advisor, larger firm, 500,000 and above in adjusted profit. And then I think the last point that's coming into this valuation trends that certainly perhaps is somewhat anecdotal, because it's something that I'm thinking about a lot, is, you know, Gunnar & Co, we've been around now close to a decade. Next year will be our 10-year birthday anniversary. And actually, if we think about the advisor market, how much has the demographic of the advisors changed over that 10 years? And I mean the sort of age of advisors. Not considerably, right? We haven't had huge fluxes of young advisors. And also what we then very often see is that client ages actually often mirror advisor ages. And so what we're finding is that we're meeting advisors that are perhaps 10 years older, than when we first spoke to them, but their clients have aged as well. And it's something that I'm certainly much more aware of when I'm talking to my clients and when buyers are scrutinizing businesses, is what is the age profile? Because 5-6 years ago, the age profile would have shifted downwards or would have been a lower level. Now we're seeing those age profiles shift, and a buyer wants to have a sustained return on investment from the acquisition of a business. And I'm talking perhaps 10 to 15 years. So if your average clients are getting into their 70s, buyers are starting to get wary around that. That gives you a snapshot of the market. As I said, we're always open to having one-to-one conversations that are bespoke to your business. So if you're keen to have that, you can use the market overview booking form at the front of this. But now I'm going to hand over to Dorian. I'm going to go on to mute, and I'm going to hand over to Dorian and let him follow. And then Dorian, as I mentioned, apologies, but if you use the next slide, please, Louise approach, I will do that.
No problem at all. Thanks, Louise, and thank you to Louise particularly and the Gunnar & Co team for giving me the opportunity to speak to all of you. Next slide, please, Louise. I don't think we need that one up for any longer. If I just give you a very brief insight into Thistle Initiatives, who I'm employed by and have been for the last 4 years, just over. Thistle Initiatives have been on the block for more than 10 years. Some of you might have come across us. You might also perhaps more recently have come across an associate compliance firm that we acquired towards the back end of last year called ATEB Compliance, particularly if you're based in the Midlands or further up north. But we cover various sectors, as you can see from that slide. I'm not going to spend any time on digital assets or mortgages or general insurance, because as exciting and as sexy as they are, there's nothing like investments, which is the team that I sit in. My current role is leading the Thistle M&A team, which is about 10 staff out of probably 70 odd in Thistle specifically. Within the investments team, just to give you some background to what we get up to, and I think the advantage is that our experience gives us a fairly comprehensive insight into the FCA's thinking. So we do a number of FCA new authorization applications, and the advantage for us in that respect is that we get to see the questions that the FCA asks in connection with those applications, which then keeps us on our toes with their thinking and where they're heading. We do also get involved in a number of FCA enforcement cases. We are used by our clients to assist them when they get Section 165 inquiries, or if they get a Section 166, which some of you may be familiar with. I hasten to add, we're not a skilled person on the FCA's skilled person list, but I think through our track record and experience and reputation, we have been permitted by the FCA to do DBT backbook reviews and undertake remediation programs. At the moment, we're up to our elbows in the swamp that is BSPS redress. So if you're involved in that, I feel your pain and I wish you the best of luck. If you need assistance, give us a shout. We do work on both buy side and sell side, as Louise suggested. And just going back to the point I made a little bit earlier about insights to the thinking of the FCA, things like the fact that very often now we see them wanting to interview new SMF 16 or 17 applicants if there is retail exposure. They're thinking on consumer duty and the like. So all of those aspects in themselves perhaps aren't hugely relevant to the decision you might have made to put your business on the market, but it's worth bearing in mind that when buyers ask us to lift the lid, those are the sorts of things that we will be looking for. If you could pop on the next slide, please, Louise. I'm conscious of time, so this is probably going to come across a little bit like a sort of a whistle stop tour, but please bear with me and we can pick up questions later. About 2,500 years ago, there was a Chinese military strategist, Sun Tzu, and apologies for my pronunciation, and he basically stated that strategy without tactics is the slowest rate to victory. Tactics without strategy is the noise before defeat. Louise mentioned selling your business in 3 to 5 years, and I suppose as part of that strategy, I think it's important to give some thought to the target market and also the current competition, so that you have in mind where you think you might fit in terms of being a target business for an acquirer or a consolidator. To me, that's the strategy, that's the long term, and you can obviously make those decisions based on your current business setup. But one of the things that you really need to be aware of is you need to be honest about the exposure you have to high risk business on your advice book, because that really is where we see the vast majority of potential financial cost in the future. And that's where we advise buyers to focus on as a risk area. I appreciate the topic of our discussion is specifically around DBTs, but we can't ignore the other high risk business that you might be conducting. And it is something that you need to be mindful of. And I guess the first suggestion I would make is that your MI and data around your exposure to DBTs and other non-standard investments or illiquids, etc., really should be tip-top. We get situations where we start looking at a firm's DBT book, and then we look at a complaint book or their complaint register, and we suddenly establish that there's a complaint about a piece of DBT advice that isn't on their DBT register. And straight away, we're scratching our heads thinking, if one isn't on, how many aren't on? So some of it is very simplistic and administrative housework in terms of making sure the numbers all stack up. And you can provide details of the number of instances of advice where you've recommended to transfer, where you've recommended to retain, where you haven't entertained any discussion whatsoever and they've been kicked out prior to or as part of a triage process. Because that's the starting point from our perspective, is to ask for that sort of MI. And through that, we will generally seek a sample of those advice files to have a look at ourselves. Also be mindful that within your DB book, there are going to be additional risk factors. I've put a couple down there: seeding schemes and concentration risk. I think there's also other things such as insistent client and those under the age of 50 who you might have advised previously. And those tend to be red flags when we're looking at somebody's DB book. You also, or buyers also, want to have the comfort that you have PI cover for your existing advice book. So as part of our due diligence, we will always ask to see your current PI policy as well as the proposal form, which again, we will then tie back to the MI that's been provided on the number of instances of advice in the AUA, etc., etc. So be aware that the complete picture is considered by any buyer, rather than purely looking at whether the advice is suitable. In terms of concentration risk, we've mentioned BSPS already. There's also been talk in the past of Rolls-Royce, etc. But we've recently seen a deal not progress because a firm had a very high, had a concentration that was unacceptably high to the buyer of a local insurance company. Now, that in itself might not be sufficient to put off all buyers because they do all have different risk tolerances. But the reality is, depending on how that business has been introduced to you, that may play a big role in the materiality of that concentration risk. And I'll give you an example. If all of those members of staff have been introduced because of perhaps a union contact or a union drive to assist people with their pensions, then it's going to be considered considerably more difficult. Or if they all met at the local golf club or social club and they continue to socialize together, it's going to be a very different perspective to where you might have had the introductions come from another of other professional organizations, whether those be lawyers or accountants or your own personal contacts, as it were. In terms of what you can do about it, it's a question of being aware of it and being able to rationalize how that might not impact the actual risk profile of your DB book. I'll keep moving on because, as I say, we've got a lot to get through. It's always a very good idea to have had an internal or ideally an external review of your DB advice. Now, generally speaking, our view would be, if that review hasn't been undertaken using the FCA's DBT tool, then it's probably of questionable value, unless the methodology is very closely aligned to the various sections and outputs of the DBT. External rather than internal. It's never an easy process to have your homework checked, and we're certainly mindful when we check both investment advice and DBT or other high-risk advice, particularly where advisors have been advising clients for a number of years, that there can be a considerable difference between what we find in an advice file and what the advisor has in their head and their understanding of the client's circumstances, which would otherwise ensure that that advice is suitable. The assessments that are made are purely done in the same way the FCA or the Financial Ombudsman Service assesses the advice, on what is written down in the file, as boring and as turgid as that is. Where you do find problems, the question is, how do you go about addressing the gaps that have been identified? And generally speaking, we are mindful that in October 2018, the FCA issued enhanced guidance, should we say, on how this advice needs to be checked. They're adamant they've never changed the goalposts, and unfortunately, as advisors, you're on hiding to nothing. So nothing you can do now can ever make that advice suitable at the point of delivery, which tends to be the basis that the FCA assesses the advice, as well as the Financial Ombudsman Service. So if one of your clients complains and you deal with the complaint and they then go to the Ombudsman, they will look at the initial advice and draw their conclusions from that point. In terms of mitigating that risk, we work with clients to undertake post-advice assessments to ensure that the objectives that the client has set themselves for that pension transfer are known, they're explicit, and they are being monitored, usually via at least an annual investment review of their transferred pension. But obviously, circumstances change, and particularly if you've advised younger clients, they may well have additional children, or get involved, get divorced, or get remarried, or sell their house, etc., etc. So your files need to reflect the current situation in an informed and objective manner. And I think if there is one bit of advice to take away, that is that by keeping your clients happy and reassured that they are working with you towards an investment or a retirement income goal, then the chances of them complaining in the first instance, or alternatively being tempted to complain either by somebody standing outside their place of work with a sandwich board saying, if you've transferred your pension, we can help you get redress, or the regulator sending them letters saying you may be due compensation because you transferred out of your scheme, etc., etc. All of those scenarios can perhaps be managed a little bit more easily if you have a content client base who are well serviced and feel like they are getting value for money. We do help with what are called periodic suitability assessments, where the outcome of a DBT is communicated to the advisor, and a specific, almost additional part of an annual review interview is tagged on. And it does need to be handled in a diplomatic and sensible manner, because you don't want to set any hairs running. But by the same token, you also want to ensure that your record keeping is brought up to scratch, and any post-advice reviews would confirm that the advice given was indeed appropriate to the client's circumstances at the time. I've talked about annual reviews and complaint handling. In terms of pre-completion of any particular transaction, obviously the buck stops with you. And being able to evidence comprehensive consideration and fair consideration of clients' complaints is always hugely advantageous. Post-completion, the likelihood is that a buyer, depending on whether it's an equity or an asset purchase, they may request certain warranties and indemnities when it comes to things like complaints or perhaps non-routine FCA correspondence. Has the FCA been asking questions about certain aspects or certain products that you've been recommending to your clients? I think, although perhaps less relevant to this subject matter, is the whole aspect of once the transaction has been completed, are your advisors adequately equipped to go into a new setup or to continue operating with someone different at the helm, or is the expectation that they all have to go through a new accreditation process and effectively start again, applying a different advice process and guidelines? Practical considerations, but not something to spend too much time on at this stage. One thing to bear in mind as well, if you are looking ahead, is whether your terms and conditions actually permit the migration of clients from one advisor to the other on a negative consent basis, i.e., giving the clients a certain amount of notice and then the transaction proceeds, or whether you have got terms and conditions which actually require the client to formally consent. To some extent, that decision on how the business is migrated will sit with the acquirer, but you can obviously prepare yourself and ready your clients if required by looking at what your T&Cs currently state and considering how best to address that possibility or potential. FCA notifications. If it's an equity deal, then there's going to be a change in control that needs to be submitted. And in that respect, if it's a MiFID firm, then the ownership or controller threshold of 10% kicks in. So you need to be aware of who's going to be need to be approved by the FCA as a controller. If, however, as Louise mentioned earlier, it's an asset sale, the expectation is that you as the seller would submit a notification to the FCA to highlight to them that you have or that you intend to dispose of certain assets. And they have a limited period, 10 days, if I'm not mistaken, to respond to that. We have seen a couple of instances where the FCA have come back, particularly in respect of DBT business, and requested indemnities or follow-up commitments from the purchaser that they're not going to halve up and close down, etc. So be aware that an asset sale in itself doesn't necessarily knock the matter on its head completely, which then goes back to the initial points I was making about the quality of your DB book as it currently stands. I think it's also relevant to restate the fact that depending on who is looking at your firm, they will have a risk tolerance when it comes to DBTs, and they may well have thresholds whereby if your DBT asset under advice volume is more than 10% of your AUA or AUM, they may well hold up their hand and say that that's too rich for them. Others might go to 15, 20%. It's not unusual. And I think Louise mentioned the easing of pressure on DBTs, as it were, or perhaps the easing of focus. And in our experience, there appears to have been a subtle shift whereby it seems to be less about the individual instances of suitability of the investment advice or the DBT advice, although that is relevant. Obviously, if you're giving unsuitable advice, you're on a harding to nothing. But a greater concentration on things like concentration risk and what is the actual makeup of your DB book. How long ago was that DB advice given? Because if it was before 2018 or the middle of 2018, the chances of it being deemed suitable using the DBAT is very small. However, if you can demonstrate that your advice processes have evolved and have improved, and that in fact the advice that you've given wasn't unsuitable, rather than being non-compliant with material information gaps, I believe we can work together to actually address any concerns that might be presented around the DB risk that your business has. Just in wrapping up, I suppose I'm mindful of the time. FCA supervision and enforcement resource, sadly, taking care of legacy DB issues doesn't add to your bottom line. It can certainly assist you when you're sitting down and negotiating multipliers and things like that, as Louise alluded to earlier on. And the better the risk profile of the business, there's absolutely no doubt that it makes it more attractive to buyers. Phoenixing is something that the FCA, as I mentioned when I was talking about sub 15 notifications, is something that the FCA is very hot on, and I think that that will continue. We have heard that they've moved some resource off the BSPS redress project within the FCA to concentrate and to try and bring consumer duty up to speed. And we've also heard anecdotal stories that the level of redress that's being calculated using the BSPS redress process isn't quite as high as they previously thought. And on that basis, there's less of a focus on that. However, just something to be aware of if you are dealing with BSPS calculations, etc. They will get, via the data string reporting that you have to make, the FCA will get all of the outcome from the DBATs, and they will get all of the outcome from your redress calculations. There are some elements that are subtly different in terms of the guidelines for calculating redress, such as retirement age, whereby the expectation when you're doing a redress calculation is to ensure that the client has a considered retirement plan for their retirement age, rather than an expected retirement age, as might be the case when assessing the suitability. So just be aware of that. In terms of how you defend liabilities, I mentioned very briefly that there is warranties and indemnities that would be talked about as part of the process, and just be aware that the potential liabilities attached to DBTs are unlikely to just go away. They need to be quantified, and probably the best way to deal with these, if they are an issue in the business, is to work out what percentage are perhaps unsuitable, or perhaps at the bottom end of the unclear or material information gap, and what financial risk might be attached to those. And then it's a case of using your PI insurance, making sure they're kept informed, taking the voluntary or the compulsory excess and doing some maths, and then negotiating those numbers into the deal on a retained basis over a period, with appropriate PI runoff cover having been put in place as well. Next slide, please, Louise. Just really to cap it all off, our approach to due diligence, as I mentioned, we do buy side and sell side. When we look at firms, quite often we will do what is called a red flag report, which is a flash report, just to make a very high level and quick assessment of whether a buyer should walk away or not. And that depends both on what we uncover in the firm, as well as the expectations of the buyer, obviously. I've mentioned warranties and indemnities and the role that they play in the SPA. I think action plans, not only does the regulator love them, but if anyone's looking at your firm and you're able to say, 18 months ago, we identified this issue, this is the action plan that we put in place at the time, these are the steps we've taken, this is what's been achieved, this is what we've still got to do, etc., etc., they are going to consider the firm far more favorably than if it's a case of, this was identified 18 months ago and it hasn't reared its head again since then. because unfortunately these things do have a habit of coming back around, whether that be at the behest of the regulator or media commentary, or clients speaking to themselves, speaking amongst themselves as well. I touched on change of control. I don't think we need to spend any more time on that. But if you have got any particular questions, then please shout in that regard, and we can certainly pick those up. Louise, I'm conscious we're just approaching Q2. I don't think I've missed anything, although I can happily come back and give further details if required, but pass back to you.
Yeah, absolutely. Fantastic. Let me just see if we've got a slide that says Q&A. We'll use yours, Dorian. So we've got lots of interesting questions. As Dorian said, if there's anything, we've got quarter of an hour, 10 minutes, quarter of an hour. If there is anything that he said that you want him to expand on, then please use that Q&A function. But if I kick off with something that came in earlier, I guess we both talked a little bit about the easing up from the FCA in terms of kind of their spotlight on the DB transfer exposure within advice firms. And you mentioned a change of focus, I guess manpower moving from looking at this to looking at consumer duty. Is there anything more to elaborate, or have you sort of covered that and what you're seeing?
I think what we have seen, Louise, probably in the last 2 years, is that initially any DBT exposure was considered a huge impediment to a transaction and given a lot of attention. And I think over the period, it's been a combination of the buyers refining their risk tolerance in that regard, but there's also been an appreciation, particularly as the British Steel debacle has continued to unfold. There's been an appreciation that actually, if the issue is appropriately managed, it needn't be the massive hurdle that it was perhaps perceived to be prior to this whole process we're going through and hopefully coming towards the end of in terms of British Steel. I appreciate we've probably got another 6 months worth of lifting and shifting to do before there are going to be follow-up confirmations of average redress and things like that. So I do think the regulator has to some extent contributed to that change as well, and really the impact on the acquirers or the consolidators is such that they are trying to foresee what the FCA is going to approach these things, how the FCA is going to approach these things. So I do think there has been a subtle softening of the stance. I don't think the tolerance of unsuitable advice has changed, and that probably won't ever change. However, the reality is that there is only a very thin slice of advice that is deemed suitable, generally speaking, in the DB space. And the rest of the advice, which is classified as non-compliant with material information gaps, or indeed too many gaps to have given a recommendation in the first place, that is really where the question of whether that advice was appropriate starts to become a little bit more important. And as I mentioned, it can never be made suitable, but it can be, the files can be enhanced and the clients can become better engaged over the decision they took to mitigate the risk of complaints and perhaps redress in the future.
Thank you. Yeah, I mean, I would echo the same. I think as we've gone through, we started with a period where everything was bad. As you said, 2 years ago, buyers, they didn't necessarily understand their own tolerance for risk, the reality, the perception versus the reality of that risk. And I think as time has gone on and there has been more detailed analysis of what's going on, I think that has, for want of a better word, calm the buyers down a little bit. My next question, it might be slightly more for a lawyer, but I thought I would ask it anyway. You mentioned a lot about PI, excesses of PI, exclusions of PI runoff. What if a seller is coming to the market with the DBT area of their business uninsured? Any experience in that, and what?
Yes, we have had some experience in that. And I suppose my starting point would be to say it all depends on whether the advice is considered good quality advice or
Good
not.
point.
And so we have dealt with various firms that don't have PI cover for their DB book. And what we've done is a review of them. And in fact, we've pretty much followed the same process, irrespective of if there is PI cover in place. I think the crucial difference is when you then get to the point where you're trying to put a value on the potential risk. Obviously, if you've got PI cover, as I mentioned, where you've got certain avenues open to you to mitigate or to limit the risk that you've got in that respect. Whereas if you don't have PI cover, it could be the limit of the assets under advice in that regard. So I think the starting point is the quality of the advice. If you don't have cover, the chances of you getting cover in the first sort of in the next instance becomes considerably more challenging. Sometimes it does depend on why you don't have that cover. Is it because your previous provider actually moved out that market, in which case it could be something to investigate with other providers. However, if it is not for that reason, then it's going to become a lot more difficult. And generally speaking, we would see a tendency to go down the asset purchase or asset sale route in that regard.
Okay, interesting. So we would assume that buyers would still be open at an asset purchase level, which I would concur with.
Depending on the quality of the advice, and that goes back to the DBT reviews and whether it's been independently assessed.
Actually, really, I think this is a really interesting question that's just come in. So somebody has said, seems likely that the British Steel situation is resolved or is likely to be resolved in a few months. I think end of March is the time frame. So following that, if you're a compliance consultant on the buy side, will British Steel pension transfer have any relevance in the due diligence that you're doing at that point? And if it will, why?
Yes, it will. Probably for 2 or 3 reasons. The first one is that it will still give a very good indication of the quality of the seller's book. If you've got tremendous problems with British Steel, then that suggests to me at a very high level that other parts of your book are probably also going to have certain challenges present in them. So in that respect, I think it will always be relevant. The other aspects in terms of saying, okay, how have you dealt with that British Steel issue? And this goes back to what I was saying about action plans and things like that, that if an issue has been identified and you can set out in a comprehensive and detailed manner how that issue has arisen, how you've identified and quantified it, and then how you've gone about actually dealing with it. I think that's the best you can do from mitigating the contagion of BSPS. I think there was a time when our suspicion was that BSPS was going to be the first of several of these similar type of issues within the DB space, and there is still that possibility without a shadow of a doubt. But hopefully the lessons that advisors have learned in terms of how to deal with these particular issues will stand them in good stead if there are other similar initiatives undertaken by the regulator.
Brilliant. That makes a lot of sense. I mean, as you said at the start, it's about looking at the whole DBT exposure in the round and not any one particular case or one particular file. So that makes a lot of sense. You also mentioned when we're talking about an asset sale for limited companies that are not able to sell their shares or their equities, follow-on commitments in terms of when you're informing the FCA. Could you sort of elaborate a bit on that in terms of what you might see as follow-on commitments asked for from the FCA?
What we've seen is the FCA going to the acquirer and asking them to sign an agreement that they will pick up the liabilities or potential liabilities that relate to legacy advice. So I think we've, it is something that we have seen, and if you go onto the FCA register and have a look on certain firms, you will see that even though they're not trading, they might still be in existence, or there might still be a notification that there is an arrangement in place that has been picked up by another company. Strictly speaking, when you wind down a company and you also go to the FCA to remove its permissions, it's at that point they could turn around and say, we're not happy to remove those permissions. And that could make it very difficult to actually close the company down. That is the leverage that the FCA has. In the same way, you can't go ahead and just appoint a director without getting the FCA's consent beforehand, unless you put in place an agreement that they're not going to be doing any regulated activity, etc., etc. But there are only a few levers the FCA has to pull on in these circumstances, and to be able to suggest to the wider public that they are looking after the interests of retail investors and the integrity of the market, etc., etc. So that is what we have seen on occasion. Not on a wholesale basis, I hasten to add, and I would suggest it is something we will probably see more of if it's linked to things like BSPS and the like. So keeping your FCA blotter unblotted is the way to try and achieve that.
Yeah, that's interesting actually, because literally last week we got word from a fairly large buyer that they have sort of really retrospectively heard from the FCA following, perhaps deals that were done last year or the year before, that the FCA is now coming forward saying, we want you to sign on the dotted line that you will keep that liability. Whereas, obviously in the past, perhaps they may have closed those businesses down and that liability eventually potentially would have fallen onto the compensation scheme. So I guess this is reducing the risk of the compensation scheme. So I think I've got two questions. If we can fit two questions in, the last one probably is fairly short. So the one being, have you seen any instances where the FCA has not allowed a director to retire from because of non-British Steel pension transfer liability?
No, I haven't. What I have seen, however, and this, to be honest, if somebody's wanting to retire, then they're not going to be concerned about hearing what I've got to say. But what we have seen is the FCA being very sticky about advisors who have given DB advice and then approach the FCA to become an SMF3, an executive director, or undertake another FCA approved function rather than a certified function within a firm. They've been put through the mill and had all sorts of interviews, etc., about their role in legacy DB advice.
Mm-hmm.
So it can become very difficult to move forward from there.
Mm-hmm. But the route to retirement with the right sort of commitments is generally possible.
I've not heard. I've heard. Yeah, I've certainly not heard of the FCA stepping in, effectively saying no, you can't go.
Yeah, Fair enough. And so my final question is, what is the cost of an independent file review? I mean, this attendee has said a file review, but perhaps I don't know if you would do sort of individual file reviews versus an overall sort of project. So, you know, if somebody came to you and said, and we absolutely wholeheartedly endorse this if you're thinking of selling and you've got DBTs, because it saves so much hassle later. But what is the cost for you to do that? And I'm going to say one more thing, just to be aware, is that if you choose not to do it before and it takes place during the process of due diligence for a sale, it's not unusual for the buyer to ask you to pay for it. So you're not necessarily saving yourself any money by not doing it in advance. Dorian.
In terms of the costs, I'm aware that there are certain outfits in the market who are offering, if I'm not mistaken, a defined benefit pension transfer file review for £100. We don't operate in the same market as that. And generally speaking, what we consider to be a thorough and appropriate DBT file check is probably 4 or 5 hours of work by somebody who's appropriately qualified and experienced and knows what they're looking for. £1,500 a file as a ballpark figure.
And if you were doing a sort of overall, you know, would you say maybe 5 files is typical, or would it be proportionate to the number of files or the number of cases advised on?
Absolutely right. Proportionate to the number of cases advised on. We might also consider the number of advisors there are, because we would like to establish whether there's anyone maverick or rogue out there. But by the same token, sampling 5 initially. If they're all suitable, then depending on the size of the book, we might say, okay, let's do a few more just to reassure ourselves. But if they're all suitable and there's only 40 DBTs, why do another 5 across the period, across the advice period, I hasten to add. So it is simple sort of, how can I put it, statistics in terms of it being a reasonable or meaningful sample. Yeah,
makes sense. And I think, you know, just having worked with Thistle very, very often popping up on the buy side, even to the extent where we put out a LinkedIn note about a deal that we completed, and James, one of Dorian's colleagues, said, oh yeah, it was great to work on that transaction. And I messaged him and I said, you didn't work on that transaction, and he did. He was on the buy side and I hadn't had the visibility of that. But I think the most important thing here is about understanding the risk from the perception of the buy side and that link to the FCA. And this is something that I don't know anyone other than Thistle that has that level of connection. So I really think that I wouldn't be going down £100 route.
That's very kind of you to say so, Louise. Yeah. So
Dorian, thank you so much. I know there are a few questions that we didn't get to, so I'm really sorry, and my team will be in touch over probably into early next week to pick up any questions that we've missed. Also, we'll be sending out a note with these slides and Dorian's contact details directly. You can see that if you do want to have a bespoke market overview with us, there's a QR code there that you can click on. And also our next webinar in October, we'll be talking about valuing your business and all the nuts and bolts and ins and outs and data analysis that we have about valuing your business. So we would love to see you there. But thank you so much for your time, Dorian. I really, really appreciate it. I know how in demand and how busy you are. So thank you. You're welcome. Thank you everyone for joining us.
Thanks, folks. Have a good day.
Bye-bye.